That's what I mean by having that right mentality. You have been diluted. We can love a company, but we can hate the stock. When you buy a stock, you're buying a piece of a business. So NVIDIA stock is very perplexing to me. This is a chip maker. They're great. They do graphic cards. They are awesome at what they do. And I pull up in our software, NVIDIA, and I look at the stock and I'm like, okay, all-time high, November 22nd, 2021, 346. 52-week low, 108. And now we're at $228. Okay. Now that in and of itself says nothing. So if you're new to the channel, I really don't care where the stock price is in the sense of, I don't look at a stock and say, oh, because it's 228 versus 40, it makes it a better buy. It makes it a good buy at 40. It makes it a better buy probably, but is it a good buy? I don't know. What I have to determine is the value behind those shares. That's what's important. So I look at NVIDIA. First thing that I look at, market cap, $565 billion. Enterprise value, 571. Essentially, the difference there is their debt. That's incredible. Very little debt. I love that. So that's a big positive for NVIDIA. Boy, look at this 1-year PE and 5-year PE. 135 and 110. Guys, you should pay a high PE if you have one of two things. High growth rate. Actually, high return on invested capital is the most important thing. And right here, they have a high 5-year return on invested capital, 17.7%. But if you look at last year's 8.3, that's pretty indicative of where profit went in the last year. And that's the issue we have. Good margins, but look at this profit margin in the last year versus 5 years. We have 26.6% profit margin over the last 5 years versus 16.8% last year. And a gross margin pretty solid. Now here's something adorable. Look at this dividend, 0.1%. Why? Why even do that? High return on equity, 18.6%. There are a lot of positives about NVIDIA, but remember guys, when you buy a stock, you are buying a piece of a business and you're buying a future stream of cash flows. That's the number one most important thing you need to hear me say over and over and ingrain in your head. When you buy a stock, you're buying a piece of a business. Now, let's go check out the 8 pillars on NVIDIA. All right, so remember, if you own the software, you can make your own custom pillars. You can put up to 12 of them, and the number of combinations is something like literally the trillions of combinations of the pillars you can have. These are the ones that I picked, and that's why I keep them here. I don't have any custom ones because these are the ones I picked. So of course, the two that stand out, very high PE, 5-year PE of 110 and very high 5-year price to free cash flow of 115. Now, if I told you that NVIDIA's revenue and profit were going to double every year for the next 10 years, I would buy this company today easily. But if I told you it was going to stay flat for the next 10 years, would you be willing to pay 100 times profit and free cash flow in order to get that? These are the questions we ask ourselves as investors. We can love a company, but we can hate the stock. Why do we hate the stock? Because the price to value is not there. That's the big key. And that's what we're here to teach as a channel. This is all great and dandy, but what do you do with this information? All this information here. The only other X here is shares outstanding are up slightly, which I don't blame them. I would be issuing shares if my stock price was really high, but keep in mind, there are a lot of value investors out there that won't even look at a company if they've increased their shares outstanding. They want to avoid those. That's diluting owners. What does that mean? If there are 10 shares in a business and you own one, you own 10% of the business. If they need to raise capital by issuing shares and they issue 2 more shares, it takes the shares from 10 to 12. But you still own 1 share, but now you own 1 out of 12 shares, 8.33%. You have been diluted. When they buy back shares, you keep your 1 share, but now you own a higher piece of the business, but you want to make sure that the company is not buying back expensive shares. That's the big key there. So let's see what analysts are saying about NVIDIA. Now, guys, you'll hear me say over and over, take these analysts with a grain of salt. I don't look at analysts like expectations here, but a lot of our users in our community love doing that. And I put it out there as information for them. But if you look as a prime example, I just said it in another video, Silicon Valley Bank 2 weeks ago had no analyst giving them a sell rating, and they were $250 a share. They're 0 today, essentially. Their bonds are selling for 30 cents on the dollar. So again, are analysts really out there for what they're trying to do? Or is it herd mentality? Now, analysts are saying that there's going to be growth pretty much every year for the next 4 or 5 years. And that could be the case. I know the chip industry, the analysts are saying it's a 12% compounded annual growth rate potential for the next 10 years. That's a lot. Let's look at the revenue growth. They're looking at revenue growth every year for the next 5 or 6 years. So there's a lot of potential. Over doubling in the next 5 years. Over doubling the revenue in the next 5 years. And couple that with a high return on invested capital, you can do well. So you've heard me talk about return on invested capital, and I keep repeating it over and over. And for those of you who've seen our videos before, the reason you need to keep watching them over and over again is because this is about mentally getting yourself in the right mindset. I still read every single day about emotions in the market, paying a low price for companies, high return on invested capital, low multiple of earnings and free cash flow. I clearly understand these things, but it's about ingraining it in my head over and over. And that's why 15 years ago, I would react if a stock went down negatively. I'd be like, oh my God, I'm wrong. Now I'm excited for it. Yes, my stock that I bought is down. I'm going to buy more shares. There's a completely different thing there. Completely different. I just said in a video today, if Google fell in half tomorrow, I would absolutely sell my soul, my fiance's soul, and everybody else's soul that I could control to get money to buy more Google. That's what I mean by having that right mentality. So guys, what do we pay for NVIDIA stock? Well, like I said, every investment's the present value of all future cash flow. But what's the thing about the future that we don't know? Everything. Now, can we make assessments? Can we make assumptions about the future? Absolutely. And that's why I always say, I'm going to copy Warren Buffett and Charlie Munger. If you can't reasonably determine what a company is going to make in the next 5, 10, 20 years, avoid it. Now, that assumption could be very wide. There's a very wide range of what a company can make over the next 5, 10, 20 years. That's why it's easier on more mature companies. And NVIDIA being a $500 billion market cap with how much in revenue? In the last 12 months, $25 billion. That's pretty impressive. Now, guys, look at this. Go look at our past NVIDIA videos. We would talk about, all right, this is ample growth, big time jumps. Is this sustainable? Well, we already saw right here. It dropped. For whatever reason, chip demand, I don't think it was that. It was more supply chain issues. But revenue fell. Let's look at profit. Profit fell. Actually, profit's almost down to the level it was at when they were doing half the revenue. Less than half the revenue. Okay. These are things to consider when making your assessments about the future. And the longer you go out in our stock analyzer tool, probably the wider the range, but you can sit there and give more assessment on what the company's going to do without the year-to-year fluctuations. Now, when I do the stock analyzer tool, I usually do 20-year analysis. You can do 10-year, 20-year, you can do 1 year to 20 years. I'm going to do a 10-year analysis here. Now, guys, this tool right here was the most popular part of our website. 1.3 million uses last year, but it's not the only valuable thing. Look at our tools. Retirement calculator, stock analyzer tool, analyst estimates, 8-pillar search. You can search by pillars, 8-pillar portfolio, our exclusive content, and you can screen by our pillars. And then coming soon, a real estate calculator. This is all available for $1 per day. We're running a special right now, $7 for 7 days. Afterwards, try it out. Afterwards, if you don't like it, just cancel. And if you do like it, you get charged $1 a day for the rest of the time. This will change the way in which you look at money. Trust me on that one. So let's do our stock analyzer tool on NVIDIA for 10 years. Revenue growth. Let's see here. Let's go with, I'm throwing out numbers here, and that's the kind of the point here. 6, 10, and 14% profit margin. Now, profit margin is down a lot in the last 1 year, but the 5-year and 10-year numbers are pretty consistently high. So I'm going to go with 20, 24, and 28. I'm going to do the same thing for free cash flow margin. Now, PE. Guys, don't fall for the trap of saying, oh, 135 PE. Don't do the meet Kevin stupid idiot thing of saying 70 PE is fine. That's a discount. No. Over a long period of time, a $500 billion company should have a very reasonable PE. Why? Their growth potential is not very good. It's not like they're going to grow at 30% a year for the next 20 years, like a $1 billion company could, or whatever it is, a $500 million company. This is a $500 billion company. So I'm going to put 15, 16 and a half, and 18. Actually, you know what? I'm going to do 16, 17, and 18. Because this is a chip leader. They do a great job. #1 graphics card. I'm good with that. Now for desired return. Guys, this is where you put your margin of safety in. If you can get 9 or 10% from investing in a long-term ETF, to get margin of safety, ask for a higher return. The more return you ask for, the less the price. It gives you more margin of safety. But I've already beaten it up quite a bit right here. So do I really need to go a much higher return than 10%? No, some investors would sit there and say, if I beat it up, I want 8%. Whatever you choose to do, that's the great thing about this tool. You can use it and determine how you use it to the best of your investing abilities. But everybody's going to have different numbers. I'm going to go with 10, 12, and 14%. Because the higher I go, the less likely this to happen. I need a higher return. Actually, you know what? I'm going to do 10, 12 and a half, and 15. I usually do 10, 12, 14 when it's for a 20-year analysis. So for a shorter period of time, I need a little bit more return. I'm going to hit the analyze button. Now, guys, the stock is currently at $228 a share. You're going to get 6 numbers that pop below. 3 values based on a multiple of earnings, 3 values based on a multiple of free cash flow. If it's all green, it doesn't mean go out and buy. All the more reason, join the community, take advantage of those $7 for 7 days. Go talk to other people, the thousands of people in this community who've signed up who are talking about stocks and talking about NVIDIA in there. You can search specifically for NVIDIA. So you go here, boom, guys, overpriced, and it makes sense. 135 PE, low price of 40, high price of 73, middle price of 50. Guys, this thing is overvalued. That's it. Thank you very much for your time.